It's Sunday the 24th of March 2019. The last video I put up was about 6 weeks ago on the 10th of February, and the gold price is really pretty stable since then. It's gone up above that and gone back below, but sitting at around the same price. But I think even as the market sort of started to falter and had this looked to be quite a bearish move down from 1340 to 1280, and threatened to sort of be that downtrends that we've constantly seen. Anytime gold gets on a run, it starts to get rejected and it gets pushed back down to the sort of that 1200 zone. Same sort of story as the last 3 years. The macro environment sort of showing a different picture at the moment, and that's why I think you saw that move really sort of hold up about that 1280, and it's been steadily rising since then, even as the US stock market's been pretty strong. And that's really down to the Fed, as I've been talking about in these videos. Since December, the Fed's really just buckled completely, and this week they confirmed that they had buckled and showed that they're not forecasting any interest rate rises this year. I think one next year, and the market's starting to forecast rate cuts. I think I saw a chart showing a 60 or 70% chance of a rate cut by early 2020. So the market's really turned around, so that the economic data is starting to weaken, and that's been supportive for the gold price. And that's what you sort of got to. Charts can only work so well, but in a market where the fundamentals are starting to shift rapidly in favor of gold, I think that's when you sort of got to pay attention to the fundamentals. So I mean, what I'm seeing here is very similar actually to what happened in 2016, as the economic sort of indicators started to weaken, and the Fed had to rapidly sort of backtrack from their previous forecast. Where late 2015 was when the Fed first started raising interest rates, and then as the economy sort of started to weaken, and the stock market started to show a bit of weakness as well, they were forced to wind back that, and they didn't raise them at all until December. But you can see here some of the price actions a little bit similar. You had that sort of spikes into March, and downtrends that sort of look like it might threaten to return back, but then it sort of held up and then sort of range traded for a bit, and then had another surge into July, where it made its sort of high for the last couple of years. And I'm thinking we can see something quite similar at the moment. The stock market had a pretty poor performance on Friday night and is threatening to sort of start to reverse. I think there's only so much. Obviously, it's been an extremely good move since December. Market's up more than 20%, but we've reached this sort of 2800 zone, 2850, which has been the tanking level for the last year now. And Friday night had the biggest down day in the I think all year. So it was down almost 2%, the S&P, and you're sort of starting to get to what's next, I guess, is the question. For the last 3 months now, it's been clear that the Fed's going to not raise interest rates, be ultra supportive, but then you get to a point where that ultra support is priced in, and now what? So now they're talking about they start talking about QE again. At some point, some people start to question if this can all keep working, and whether it will save the economy from rolling over, and it doesn't look like it is. I think the GDP figures have been weakening in the US, and a lot of the bigger sort of macro indicators have been weakening. Hence, why the Fed sort of trying to turn. Of course, that's the Fed's turn is mainly due to the stock market, in my view. But I think these indicators are starting to show weakness in the broader economy as well. That has been evident for a while, but it's starting to. I think it's the pace of change is becoming a bit more evident. So, in an environment where the S&P has rallied and gold's been holding pretty firm, that's generally very positive, because to my mind, I think there's considerable downside risk to the S&P in the next month. Usually you don't have a surge of 20% and not see at least a 5 to 10% correction or more, but that should be pretty supportive for the gold price. Obviously, Australian dollar has, in a market where we've had a pretty strong sort of risk on trade in terms of money moving back into stocks. That's generally been a pretty positive in the last 5 years. For example, the Australian dollars tended to rally in that environment. but it hasn't been able to all year. It's been trying to move up above sort of say 72, and you can see this downtrend here. It's looking pretty extremely weak, and I think there's where a couple of if we can get a couple of bad economic indicators coming out, like retail sales or something in that order that shows a significant weakening. If you get a couple of those in a day or two, that could send this 70 cents level going, and then all bets are off about where the Australian dollar can go. Obviously, it would be uncharted territory aside from that in 2008, 2009, in the depths of the market downturn. Haven't seen that 70 cent level breached for long since then. So I think you're heading for that next leg down in the dollar. But it's holding up quite well, and I've been quite bearish on the dollar, and when you're as bearish as I have been, and a lot of macro sort of people are bearish on the Australian dollar, you sort of start to wonder, oh, well, maybe it's priced in, and I don't believe it is. I think that the some of the weakness is priced in. The market's probably pricing in Australian interest rate cuts at some point, but I don't think they understand like the broad sort of understanding is of a incredibly weak economy. But if that starts to show itself, I think you can see significant downside pressure here towards say 60 cents, and it wouldn't surprise me if that happened in fairly rapidly, especially if the broader sort of worldwide market start to tank in tandem. That would be an extremely bearish sort of scenario for the Australian dollar, with domestic weakness as well. So I still think that's on the cards, but can keep going sideways here for a while, but it's gradually weakening, and I think some point 70 cents cracks, and probably cracks pretty hard. Obviously that's been quite good for the Australian dollar gold price, back up toward sitting on its all-time highs there again, that it's back up to 1850 now, and the all-time high, I think weekly close is around this sort of 1870 level now. As if we see that break below 70 cents on the Australian dollar, I think that could be the surge up to past 1900 again, past 1900 for the first time. And generally, if we're seeing an environment now where gold is sort of the strongest of all currencies. I guess it's strengthening against every currency, because the US dollar has been pretty strong in the last 3 months, and gold's still been doing well, which is an indication of, in currencies other than US dollars, gold's been doing even better. So I think Australian dollar gold easily sort of can go above 1900 on that break of 70 cents Australian dollar, and head up toward that 2000 level that we've been looking at for a while. I might just briefly look at the XJO chart as well, the ASX 200 Australian index. I think that's starting to sort of show a bit of weakness here. It's been gradually sort of topping out, struggling to make it past this sort of about this 6200 level. Obviously, I'd expect that with the S&P down on Friday night Australian time, you'd probably see a decent size move down in the index tomorrow. There's been a few factors in favour of some of the mining stocks in the last few months. With that Australian dollar weakness, the iron ore price and the coal price have also been extremely good in US dollar terms. So you've seen this sort of divergence where the currencies remain weak, but commodity prices in US dollars, or the main commodities for the some of the big miners, have remained firm. And partly that was down to, in the case of iron ore, that was the tailings dam failure in Brazil from Vale that's caused a bit of a short-term burst in the market there. But I think you're gradually starting to see these things roll over. And there's also been, I think, a broad move in the Australian share market, because they want that lower currency has been helping. But I don't know if the market hasn't really caught on to why the currency is weakening. In my view, that's because of the economy starting to struggle. And obviously, if an Australian economy struggles, you'll start to see the share market start to roll over as well, because a lot of the components of the index are heavily reliant on the consumer and on consumer debt, for example. So I think you've seen that this is sort of this bad news is good news sort of stuff that you've seen in America for a long time, and Australia's starting to behave in the same way. And that's also moved. we've had this 15% up move since December. So I think that the index is ripe for rolling over here. And typically if the US market's starting to roll over, the ASX will roll over just as hard. So I think there's a high likelihood here of a bit of a move. You can sort of say that it's sort of this 6200 is a bit of a level. It cracks down there. I don't know. You might see it move back down to sort of 5900 pretty quickly, which would be this sort of zone around here. But I think anything's possible here, and it's particularly if the economic indicators start to weaken and people start to view the share market as a function of the economy instead of just floating on its own. So that's I've been bearish for a while. I've been adding a short position here. Probably got in a bit early, but I've also been adding around here. So I think there's a good downside opportunity here in the next few months. And we've got the election coming up. There's a little bit of uncertainty as well. So I don't think that's typically not going to be a strong period for the share market. So all in all, I think it's shaping up to be a pretty interesting period over the next 3 to 6 months, particularly for gold. We're seeing sort of rapid declines in a lot of economic indicators, and particularly in the Fed, as I said, and that's the question is now what's next. We're at the end of the interest rate hiking cycle. The Fed's going to stop selling bonds as well. So they're sort of going to be left with all these bonds on their balance sheet, and it's kind of the market's now sort of what else have you got for us? And the sort of the stuff I've always read and heard is that if QE came back, it's going to have to come back in a bigger way. If you saw a QE4 come in that's even bigger than say QE3 was, and that could really surprise on the upside in gold, for example. If I don't think the gold price has factored any of that in, but if we see this sort of deterioration in economic indicators and it starts to spook the Fed, for example, they'll have to come out and say that they've got all these other bullets left, but you get to that point where the markets now you've had 3 tries at QE, for example. We're not sure if that's going to work again. So I think if you see a loss of confidence in the Fed, that would be ultra bullish for gold in the near and medium term. So I think we're getting to a point now where it's you often see some pictures of the Fed represented as like the Wizard of Oz, and the wizard sort of being pulled out from behind the curtain and showing his levers, and there's not much to him. And I think at some point we're getting to that. We're getting closer and closer to the point where people start to question whether this can keep going forever. With this sort of basically just now it's pretty blatant manipulation of the economy and the share market. And I think that's the point at which gold was always going to do well. It's taken a lot longer than a lot of people thought, but there's a potential here. And obviously, if you had that, that would coincide with probably a break above this, say, 1400 move and an extremely good move and an uptrend. And that's obviously when charts and fundamentals start to line up. That's a really good environment. So we've had this big basing pattern, and that would be a move up to say sort of 1600, 1800. That's sort of the over the next 2 years, for example. But in an environment where things are deteriorating, nothing's sort of off the table, I guess. So that's sort of the medium longer term picture. At the moment, you can say that gold's is pretty stable around here. And as I said, I think we could see something similar to what happened in 2016, where in the same sort of environment with the Fed having to back off interest rate hikes, and that should be pretty positive for gold and the stocks. And I'll talk about some of the stocks in another video.